Okay, good afternoon, everyone. My name is Khai. Thank you for taking your precious time off in joining me in this webinar on how to recession-proof your financial plans. I'm sure you'll go away with a couple of tips on how to enhance your financial plans. Along the session, at the bottom of the screen, you can see a Q&A chat box. Do leave your questions over there, and we'll try to go through at the end of the sessions. With that, let's get started. So first, I'd like to say that this information that I'm sharing is based on my personal opinion and experience, and that it's really from a practitioner point of view rather than representing any particular company. This will be the agenda for today. It should take about 45 minutes to an hour. So hopefully at the end of the session, you will go away clearer about your financial plans and financial planning. Like what I say, any questions, do leave in the chat at the bottom of your screen. So before we get started, a little bit of background about myself. I graduated in 2005 from NUS with a Bachelor in Electrical Engineering. I spent the first 5 years of my career in an industrial automation company as a project manager. And I started my career in financial services in 2011. I'm a chartered financial consultant. I help busy professionals in their journey to financial clarity. I believe very much in holistic advice in financial planning, insurance, and investments. So having an engineering background means that I have a systematic process to make sure that I approach my clients from a bottom-up approach to make sure that they are clear about their financial portfolio. And with that, then we are able to look at any redundancy, obsolescence, or loopholes in their financial program. Outside of work, I'm passionate about running and soccer. I'm 40 this year. These are my 3 kids. They are 4, 6, and 8. Yes, in case you're wondering, we did have an elder daughter. She was born in 2010. But unfortunately, when she was born, she was diagnosed with a genetic disorder, such that her body could not process protein in milk. And the byproducts were toxic to her central nervous system. She spent the first 2 months in ICU, and in that year, we actually visited the hospital a lot. So during the year, we incurred medical expenses of up to about 50,000. Unfortunately, the bills could not be covered by insurance back then. So, and at the end of the year, unfortunately, she left us. So actually this personal experience is one of the reasons why I came into this industry. I have a strong conviction to make sure that my friends and clients would never have to go through the financial stress that we did. I guide my work with a very simple principle, that is to partner my client in their journey to financial clarity, because I believe that the financial planning process is a long journey. So it's more important for me to create trust and build long-term relationship more than anything else. Over the last 10 years of my career, I think these are the 2 major problems that consumers face: frustration and confusion. Frustration may be because of the lack of advice or the lack of service, and confusion probably because of increasingly newer and better products that are being introduced into the market and compounded by complicated government schemes like MediShield, MediShield Life, ElderShield, CareShield Life, and CPF Matters. So with that, let's get into the topic proper. So I'd like to go through some basic concepts about a financial plan and insurance plan. So what is financial plan and financial planning? A financial plan is a comprehensive overview of your financial goals and the steps you need to achieve them. So this will include cash flows, savings, debts, insurance, investments, etc. So, and of course, financial planning is the ongoing process of doing that, and to review your financial situation and develop strategies to achieve your goals. If I were to put it in a very simple diagram, I think this should be it. And I think we are fortunate enough that most of us don't really have to worry about basic needs. So the first step of financial planning is really to lay the foundation in terms of protection. And the second step after doing so would be to save and accumulate towards your medium to longer term goals. And of course, when we are no longer around, how do we distribute the assets that you have built up over time efficiently? So I think this triangle will pretty sum up what financial planning is about. I'd like to go through a couple of myths about financial planning and insurance planning that I come by these couple of years. Myth number one: financial planning is buying insurance policies. Is that true? And of course, it's not really true, because insurance is really only a part of financial plan. There are other areas which I mentioned just now, including understanding your cash flow, assets and liabilities, your net worth, and doing retirement planning and estate planning. So insurance policies are only part of a financial plan. Myth number two: financial planning is only for the wealthy. Well, that's partly true also, but of course, financial planning is for everyone, as long as you want to be more financially successful. So financial planning, if you want to do financial planning, you can either do it yourself or engage an advisor. And but of course, we recently came across this article from Forbes, whereby they say that the value of financial advice gives 3% better outcomes for consumers. And some myth about insurance, and from a recent seminar that I did, right? I think that I'd like to go through the top 3 common insurance myths that consumers might have. Myth number one: I have multiple insurance from different or same companies. I cannot claim from all of them at the same time. So is that true or false? So the answer is yes and no, because most of the policies, as long as they are enforced and it's a covered conditions, you can claim from all the policies that you have, with the exception of reimbursement of medical expenses, because you can only claim up to the amount incurred. That means if you do have you have overlapping policies on medical expenses, you might want to take a look at that. Myth number two: what if my insurance company fails? All my policies and monies will be all gone. So luckily, this myth is also false, because policy owners are protected by this PPF scheme, which is a safety net for all policy owners, and it provides 100% protection for the guaranteed benefits of your life insurance policies. And the last myth that I want to go through is, I have a hospitalization cover, therefore I do not need a critical illness plan. So yes and no, because hospitalization cover and critical illness cover are really 2 different type of benefits. Hospitalization, of course, is to reimburse your H&S expenses, and as long as you require the treatment. But for critical illness cover, a lump sum is paid out to you in the event that you're being diagnosed with one of the covered 37 conditions of critical illness, or maybe for early stages or intermediate stages. So with this 5 myths, I hope that I can clear some of the questions that you typically a consumer might have, or you might have. So a quote: when you don't need it, you buy when you don't need it, and when you need it, you may not be able to buy. And this obviously relates to buying insurance. And with that, I'd like to go through some of the basic concepts about insurance and the types of insurance plans. So what is insurance? Insurance is really the risk of the transfer of a risk of a loss. This loss can be due to death, disability, critical illness, or incurring large medical bills. And the insurance company are the one that actually do the risk pooling. That's why we buy insurance from insurance companies. And how much does insurance cost? Let me give you a very simple example. Let's say for a pool of 1 million 30-year-old people, and the statistic shows that if the statistic shows that there are 10 deaths out of a million 30-year-old every year, assuming that every one of the 1 million people wants to insure each 100,000 of cover, so the cost of insurance would actually be just $1 each. So this is actually insurance. Insurance is a leverage. You pay a certain sum of money, you want to transfer the risk of this loss. And what are the different types of benefits that you can get from buying insurance policies? Some of the more intuitive one I will not go through, but there are some of these are sometimes cause confusion, which I want to go through over here. Total permanent disability. So in physical terms, it means that if we consider two hands, two legs and two eyes, if you lose any two out of these six, you're considered to be totally permanently disabled. However, if you suffer a disability which disallow you to which let you become totally permanent disabled and not able to perform any work in future, then this is also considered a TPD claim. If you have policies from some time ago, and it covers critical illness, and very likely it will only be covering advanced CI. And advanced CI, if let's say we use a very commonly claimed condition like cancer. So advanced CI would mean that the cancer is malignant and spreading. Probably most of the time should be stage 3 and above. However, because I think more and more people are detecting cancer at early stages, so this early CI become a gap in some of the consumers on some of the consumers, which means that early cancers like stage 0, stage 1 or 2 cancers, cancer cells that are malignant but haven't spread, you need to have an early CI to be able to claim. So the types of insurance plans generally will fall under term, participating plan or PAR plan, or investment link policies, ILP for short. A very general overview of their characteristic is a term plan has no cash value. It could be plans like term life, critical illness, and participating plan will have cash value, and plans like whole life plans or savings plans which has cash value, endowments, education, retirement planning, all these are considered PAR plan. And investment linked policy will combine protection with underlying investments. If we do a comparison, I think it will be easier to understand. Let's say when we compare term versus whole life, right? Term has no cash value, whole life plan has cash value, and obviously term has a fixed term. That means you need to specify how long you want to buy for this plan, and it's yearly renewable. So you take it like a very easy analogy will be like for buying term insurance, you're like renting a flat. But if you have a whole life plan, the plan belongs to you because it can cover you for whole life but typically until age 99. And nowadays, I think most of the whole life plans are limited payment, usually 15 years, 20 years, or 25 years. And because they cover you for whole life, generally you will also be paying higher premiums and you own the property. If you compare a PAR plan with an investment linked plan, both will have cash value. And the cash value, the premiums are being invested in a different way. For PAR plan, the premiums are put into a life insurance fund, which they call it a PAR fund, participating funds, whereas investment link buys into underlying investment units in managed funds. So a PAR plan will have guaranteed and non-guaranteed benefits, whereby insurance linked policies generally should be all non-guaranteed investment returns. However, investment linked policies do have flexibility like premium holiday, partial withdrawal, where if let's say you were to loan your policy value from your PAR plan, you're actually taking a loan at maybe 6 to 7%. So some of the typical type of PAR plan that you have will be whole life plan, endowment, retirement plans. Investment link can combine protection. It can be a single premium or it can be regular premium investments. So just like what I mentioned, right? PAR plan, PAR fund they have investments. They involve investment, but of course it's being managed by the insurance company. However, if you do an online search, you can easily search for the PAR fund update of all the major insurance company. So this one over here, I show you what I'm showing is what I can get from Prudential, Income, and AIA. They'll show you how much is being collected, how much the investment returns, and what are some of the major holdings that they have. So if you are interested, you can do a Google search. It will be quite simple. Just search for PAR fund update. So with insurance, the other portion about financial planning will be savings and accumulation. So when it comes to savings and accumulation, these are the different types of instruments that you can have. Like, of course, everybody will have a salary coming in, then this will go into your cash or fixed deposits. So whenever you have a bit more money, then you think about doing investment. So investment can come from these few different places, like whether you're buying a bond, you buy into equities, or you buy into the bank structured products or structured products from the insurance company, or you can do unit trust funds investment to let someone manage your money. However, of course, different instruments will come with different risks and returns. And generally, lower risk means lower return, and higher risk means higher return. This is a curve that you can easily get from the internet. So cash being the safest, then bonds are usually safer than bond will generally be safer than shares. And of course, large company shares versus small company shares, the risk goes a little bit higher. So, and you expect higher returns if you were to buy into for example, a bond from a company versus a bond from the government. So another quote: financial planning is simple yet difficult. I think that's because we don't wake up every day to think. Nobody wake up every day to think about financial planning. So really, it is about discipline, having setting up plans to do it, and let it auto run rather than someone coming up, but rather than doing financial planning on an ad hoc basis. So it's important to have plans that run on its own. And that's where either you do it yourself or you engage an advisor to do it. So on the protection part, I'd like to go through some of the common safety nets for all Singaporeans and PRs. So these are the safety nets that most of us should have, unless you opt out. And of course, some of the schemes you can't really opt out now. So dependent protection scheme, when you start to contribute CPF, you will be enrolled into this scheme. And it is a 46,000 cover up to age 60, covers a person on death and TPD. So based on the premium calculation, I think it's really a very, very cost-effective plan. And I've heard some people opting out of DPS, but generally, I think in my view is DPS is a really very good scheme. Just let it auto run, as you have an additional 46,000 cover on your life. And if you have not done anything to your medical plan, you will minimally be covered by MediShield Life, because when MediShield Life replaced MediShield from November 2015, all citizens and PR were enrolled into this plan on a mandatory basis. However, MediShield Life is a hospitalization plan packed at public hospital wards B2 and below. And he has a rather low limit of 100,000 per year, although there's no lifetime limit. And but of course, most people in Singapore, most Singaporeans and PR, based on the statistics, about 2/3 of Singaporeans and PR, they actually do have integrated shield plan of some form. So integrated shield plan means that why is it called integrated? Because the additional cover that you purchase on top of your MediShield Life is what is being offered by the insurance company. So if you have one of the shield plan from the companies below, then you would have an integrated shield plan, and this integrates MediShield Life into it. So when that happens, you will, instead of dealing with CPF, you will just communicate with the insurance company that you buy into. And of course, and I'd like to emphasize the importance of having a proper hospitalization cover, because just like to show you two claims that what my clients had in recent years. So this is a client age 61. So the policy owner bought a plan for his mother, and in 2019, there was a claim for doing a cataract operation. So this is a claim just to show that one side of the eye at a private hospital is about 10,000. So for both, it was a total claim of about 20 over 1,000. So this could be a typical operation in private hospital could amount to 30,000. But if let's say something is more complicated like this, So I have a client who was 39. He suffered a viral heart attack. He was very young, but it was not because of his health. It was something. It was viral. It couldn't be explained. Even the doctor couldn't explain. But luckily, he had a shield plan that also with a rider that covers 100%. So the premium he paid at the age of 39 was actually just about close to 700 plus per year. But he was hospitalized in a private hospital for almost in a private hospital plus the government hospital for almost 3 months. So the bill that you see here, which comes up to 800 over thousand, is what was incurred in the private hospital for 2 months, and because he was on life support. And after we transferred him, because we are mindful about the limit, so we made a decision to transfer to the government hospital, National Heart Center, and there was another 100 over thousand incurred. And with the follow-up, the total claim was close to $1 million. So this was one of the biggest claim that I came across. It's a bit one-off, but really, I think anything can happen. And with the transfer of this risk to the insurance company, I think we can take our mind, we can have peace of mind to know that actually we don't have to worry about huge medical bills with a simple shield plan upgrade. And in the last couple of months, there was also introduction of CareShield Life. So before CareShield Life, it was ElderShield. So ElderShield, or whether ElderShield or CareShield Life, is a long-term care insurance whereby it tries to cover us for disability. And if you are unable to perform 3 out of 6 activities of daily living, like what you see on the top right? So if you can't do 3 out of 6 and certified by a doctor, you will get a payout. For ElderShield, you'll get a payout of either $300 or $400 for just 6 years. And that's the reason why we also have a supplement scheme whereby you can top up on top of your basic ElderShield. So you can get from private insurer, like for example, Aviva, you can get a MyCare Plus. Then that will increase your payout from 400 onwards to even to a maximum up to 5,000. Because ElderShield payout seems to be a bit insufficient because it was $400 a month, right? So after review from the panel from Ministry of Health, they decided to launch CareShield Life, which gives a payout of $600 per month, and the limit, the payout limit, the duration was taken away. That means this CareShield Life will pay $600 a month for lifetime, even under the basic scheme. And they also try to future-proof the scheme whereby the payout of $600 can increase with inflation. At the moment, it's about 2%. So with CareShield Life, you can have increasing payout until the moment upon claim, right? Then you have a higher payout, and you can calculate based on the number of years from the first year that you're enrolled in. So most anyone that is above 30 years old will be under CareShield Life already, and those born in 1980 onwards will also be 1980 and onwards will also be on CareShield Life. So if you're on ElderShield, probably in this couple of years, in this year or next year, they will give you an option to get into CareShield Life. So, but there's no details yet. And likewise, even for $600 a month, maybe CareShield Life might not be sufficient. So you can also upgrade. You can also do a supplement plan based on your CareShield Life plans that you have. So, so what are the key considerations for having a holistic financial plan? Just now we mentioned, right? Financial planning is really it's really quite simple. It's really to take care of to lay the foundation and to save and accumulate over time. So when we want to have a financial plan, I think we need to lay the foundation proper. So I think these are the 5 key considerations that you should consider when you're planning for your own financial plan, or when you're discussing with your financial planner. So emergency fund, foundation, laying the foundation, budgeting goals, and having regular review. Number 1, emergency funds. So emergency fund is not a fixed number. because but of course it's a liquid savings based on a factor of your monthly expenses or income. So we go with a few guidelines. The most minimum guideline will be at least 3 to 6 months of your expenses. That should be the bare minimum. However, if you have a bare minimum as a liquid savings for emergency, right? Then a prolonged kind of negative environment might not be beneficial. For example, for last year, let's say if some people get out of job, so if you only have 3 to 6 months to cover your expenses, what will happen if the pandemic drag on? What happened? So if you want to be a bit more comfortable, then you might want to go for 3 to 6 times of your monthly income. Then of course, monthly income should definitely be more than expenses. Or if you want to be very comfortable, you want to make sure that in terms of emergency, you do not have to worry too much. Then you can go for even more than 12 times or more than 12 months of your monthly income or expenses. Then this one question I came across recently when one of my friends posted, what is the amount? So what's the amount that you need in your bank for you to sleep soundly at night? So you can link that with your emergency. How much do you need to have in your bank for you to feel safe at night when you sleep? So number 2, laying the foundation. I feel that the first step of a sound financial plan has to involve insurance and protection planning, because if there's any unforeseen circumstances like hospitalization, critical illness, death, disability, or accident, we do not want all these unforeseen circumstances to wipe out your savings. And of course, most of us will probably have some plans from last time until now. So over the years, you would have bought different policies over the years. But when everything comes together, I think that's where you probably want to check whether there's any redundancy, obsolete plans, or loophole that different planners have introduced, have recommended to you. So I think it's important to check whether what you have and to know what you have. And so the thing is, of course, some people do not believe very much in that. But the thing is, right, if let's say if something happened, if there's an illness or accident, would you want to think about it? Would you want to pay your medical expenses out of your own pocket? So as a practitioner, I feel that it's a better idea to transfer this risk to insurance company for a certain amount of premium so that you can have peace of mind. So number 3, consideration for sound financial plan, budgeting. So look at this two simple statement, right? Look at this question. Are you a spender or saver? So are you type A or type B? In fact, it's the same equation, right? Whether is it just savings on the left or expenses on the left. So if you are type A, I think you should give yourself a clap, because if you are type B, you should give yourself a clap because you only spend after you save. Yeah, I think type B will be, being a saver will make sure that you'll be more aware about your expenses. After you set aside a certain amount of savings to your bank after you get a pay, then you work on how much you can spend. And being a type B, I think it probably a better idea. So if you're type A, maybe think about it. How can you slowly convert or adjust your lifestyle towards type B? So if you want to be very clear about what is your cash flow, then you can do a financial health check. So a cash flow will mean that knowing how much you take in on a monthly basis and splitting itemizing all your expenses, such that you can get a very clear picture about your monthly in and out. So a financial health check is something that I do with my clients. And if you want to do a very simple calculation, there's a lot of budget calculator or expense calculator online. So this is Money Sense. It's a government website. You can just use the budget calculator to estimate your expenditure and to set up a budget for yourself. So number 3, budgeting. And number 4, of course, to have a financial plan is, of course, to set goals. So these goals can come in the form of short to medium term or medium to longer term. Shorter term, probably maybe you want to buy certain items that you really want to buy, or you want to have a bigger, I mean, you're looking at buying a car or saving to buy a property. So that can be short terms. Medium or longer term usually will be again, of course, property. Then if you have children, then children education. And other than children education, whether you're single or you're married, probably you should think about your own retirement and future lifestyle. And when we are no longer around, how you're going to pass it down? How are you going to distribute your wealth efficiently? That's legacy planning. And number 5, of course, to have a sound financial plan, you need to regularly review your plans. So always remember this 1 to 100% rule. 1 year from now, your financial and your personal and financial circumstances will 100% be different. So it's important to do regular review. So the second part of the financial planning to me is really on savings and accumulating for medium to long term. And with that, you definitely at some point in time, you might get into certain instruments. So, but whatever that you're getting into, I think there are 5 key principles to consider to make sure that you try to follow. So number 1, keeping sufficient cash and be aware about the inflation. Number 3, have a long-term view, diversify what you're how you're saving, and of course, if you're investing, to have time in the market and not timing the market. Number 1, holding enough cash. This I've explained to you is really your emergency cash. There's no hard and fast rule about how much. It's really how much you are comfortable with. But you will get to a point whereby too much of emergency cash might not be working hard enough for you. So you have to do your own calculation to see whether what is sufficient and what are the spare that you can set aside for your own savings and accumulation. Number 2, I think we have to be mindful about the inflation. So this is a chart that these are the data that I got from the Department of Stats. Over the last 30 years in Singapore, the inflation averaged at about 1.7%. So what does 1.7% means to us? So inflation do have an invisible effect, because if you have a lump sum of 100,000 now, and you just keep it in cash totally, so over the years, over a period of 5 years, 10 years, 15 years, 20 years, in fact, the value, the purchasing power of this 100,000 will reduce. So in 10 years, what you can buy with 100,000 today, you can only buy something that's worth 84,000. So the value of 100,000 will be diminished, and it'll be over time. It's something that is slowly creeping into. So this inflation rate is something that 1.7 is something that you might want to be aware about, or you can just round it up to 2%. So having a long-term view, if you are investing, this is a chart that is gotten from based on the MSCI World Index. So this shows a rolling 1-year returns. So in a single year, the returns could swing from 40% plus to minus 40%. So obviously, the minus will be the minus 40% was the global financial crisis, and the 40% was the recovery from it. So over the short-term markets are volatile. I think this is very evident. But however, if you have a longer-term view, then the rolling 10-year returns, in fact, most of the time will be above 0. So there's only a couple of years whereby it was negative, and of course that was during the financial crisis. But otherwise, if you have a longer-term view, then the volatility becomes more insignificant. And if we put it together, that's how the rolling return, the 1 year and the 10-year rolling return will look like. So it's really how you have this mindset about longer term, and having a longer term view can affect your decision also, because and it's important when you're investing not to panic. The number 4 principles will be to diversify. Okay, if you were to take note of the gray color boxes, which is the emerging market equities. So every year you can see that different asset class perform differently. So if you're always chasing, if you're always trying to chase the best performing assets, then you might get it wrong, you may get it right, but you may also get it wrong. So imagine if somebody was chasing commodities, the emerging markets, equities in 2010, it happened to be the worst performing in 2011. Likewise for 2017, in 2018, emerging markets was the worst performing. So that's the reason why we in investment, I think we advocate diversification, because you will never know which asset class or which region will perform. Because things are, I think in recent times, things are very unpredictable now. And the last principle of investment will be the time in the market and not timing. So if you look back over the years, right, one thing for sure is there's always more positive years than negative years. And if you looked at the gray dots below every bar, right, that's the maximum drawdown in that particular years. So I'd like to draw your attention to 2009. In 2009, the maximum drawdown was minus 23%, but in the end, the year ended positive 27%. So if you are an investor that got out at when you panic and getting a loss, then in the end you might lose out on the market. When market rally back, you will lose out on the returns. So time in the market is more important than timing the market. And another chart that can show you what's the effect if you were to stay invested over a period of 20 years. Same thing from the MSCI World Index. If you stay fully invested based on 100,000 for 20 years, you would have a returns of about 321,000. However, if you try to time the market and you miss some of the best days, your return might be a lot lesser, or you might even be making a loss. So if you have panic and got out at the wrong time and go in at a high, and you keep repeating that, then there would be a problem if you're doing investments. So let's come to this the main topic of this webinar, which is how do we recession-proof your financial plan? If given that like a pandemic like COVID-19 persists, right? If the situation is not getting better or something happened to your job, then how do you make your financial plan more resilient? So I think there are 5 key principles that I like to go through. So number 1 principle is again, so you see I keep repeating this, keep sufficient cash, because having sufficient cash with in your emergency fund, and because it's liquid, will prevent you from making irrational decisions, or will prevent you from the need of liquidating your investments at the low. So it's always important to keep sufficient cash, and when it comes to planning for your financial when you do a financial planning. So always be mindful about that. And of course, number 2, we have based on the cash flow, if you have worked it out, then probably you will know that how much you can afford to set aside for your financial plans, or for the different various products that you are buying into. So the affordability is very important. And if you stretch yourself too much, then when it comes to a recession, you might not have the bandwidth to react. And number 2 and number 3 will be could be tied together, because if you are committed to plans, that are not flexible, then you see that you have locked yourself in for a longer period of time. Then the plan not flexible for you to stop payment or adjust. Then you might have problem when the recession hits us, right? So committing to plans that are highly flexible and adaptable will be ideal. And of course, number 3, on the topic about the different financial instruments and insurance plans that you put together. So for insurance plan, right, I've gone through the term insurance, the par plan, and investment link plan. So it's very there's no right or wrong about which type of plan you should be taking. But generally, term will be more highly leveraged. It means you can get protected for more with a lower premium. Then par plan will be on the more heavy side, whereby because you pay for a certain number of years and you get insured for whole life, right? Generally, premiums for whole life plan will be higher. And investment linked policy have the flexibility to give you, to allow you to do adjustments such as to let you take a holiday, premium holiday, or withdrawals of the funds. So if you have plans that are more, you have different plans coming together, that might be a more ideal situation. And of course, the financial instruments that you go into, whether are you being locked down for short term or long term. So these are the questions that you need to ask yourself. And number 4, of course, to diversify. If you put everything in a single basket and something happens to that, then that will be a problem. So the key principle, number 4 principle, is to diversify what you are investing, or diversify what you have, what you have in your financial plan. And number 5, again, long-term view. Taking a long-term view will allow you to take a step back to look at what is your overall objective for the year, for medium to long term. So I think that's important. These are the 5 key principles, and when I'm meeting clients, these are the things that I'll go through with them. And if you are doing investment, then number 4 and number 5 will be what I emphasize to them a lot. So I'm mindful of the time that you're here. So if there's 3 points that I'd like you to take away, that would be, I think that'll be like financial planning. Number 1, financial planning to me is a long journey. It's a long journey. Our circumstances can change, so review your plans regularly. And number 2 is if you have not do anything, I think doing something is better than not doing anything. Of course, when you are buying into whatever products that you're buying into, you'll be good that make sure you understand what you're buying. Yeah. So number 2, doing something is better than not doing anything at all. And in terms of the priority of financial planning, I will always think that you'll be in this order, whereby you take care of the protection, in terms of hospitalization, critical illness, then followed by death, TBD if you have dependents, and then optionally maybe you want to look at accidents and disability. So after laying the foundation of your financial plan, then it'll be good to take a look at your medium to longer term savings goal, and whether your savings via a safer instrument or an instrument that suits your risk and reward profile. Okay, so before I go into Q&A, if you are interested in the slides, or you want to have a checklist on the review checklist that I give to my clients, maybe you can drop me an email. Then if there's anything I can help, you can reach out to me. So it's about it's 42 minutes. I think, thank you for your time. If you are still around, then let's check out for any Q&A that we might have. Okay, so I think it's a rather quiet afternoon. Let's wait for a few minutes for Q&A. And if not, is there anybody that want to ask any questions? You can feel free to put it in. So okay, so regarding the slides, right? If you are interested in the slides, if you are interested in the slides, I think when you register for the webinar, you will have the email to notify you, right? So you can just you can reply with that. Yeah. So if you are interested in the slides, I'll send it over. Then of course, after today, you should get a thank you email, so you can reply to that. So yeah, I'm happy to share. We'll be happy to share the slides with you guys. Okay, So thank you for joining me for the last 45 minutes. I hope it has been beneficial. I think it's more important I think it's important for everyone to do your own personal financial planning, and whether you're doing it yourself or you're engaging an advisor. I think these are some of the key considerations that you might want to think about. And of course, there's no right or wrong. There's no right or wrong, and there's no right or wrong about the decision that you make. There's always, usually the decision will come after a discussion with a financial planner, and yeah, that's about it. So thank you everybody for attending. I hope you have a great day ahead. And yes, thank you very much. If anything, just reach out to me by email.